Welcome everyone to our YouTube live, and I think we're going to have the usual session. It's going to be an hour together, and you can ask a question, whatever question you like, as long as it's to do with finance. And maybe we'll start off just quickly looking at markets, just to see what's going on, because it's been a little bit of a turnaround for the Nasdaq. Not huge, but a little bit since we last spoke. Oh, Teddy's arrived. He always arrives at the beginning and the end of sessions, so let's just give him one quick treat. We've only got the crunchy ones today, so apologies for the noise. There you go. Yeah, okay. He's going to crunch that very quietly. Not quiet. Okay, let's have a look at markets just quickly. We can use Coifin to do that. And I'll share with you. There we are. So certainly if we look at the last, well, let's look year to date. You can see the size of the Nasdaq rally. It's up, still up 39% year to date. The S&P up 17. Government bonds. This government bond fund has done basically nothing. It's gone up 1%. But you can see the turnaround that we've had over the last month or so. So it does seem as if the Nasdaq has lost direction. So a lot of that hype, which was driving those mega cap tech stocks higher about AI, has effectively started to subside. And the stocks which have got the least support in terms of valuation certainly have suffered as a result. So if we look at the factor performance, so let's have a look at the factors, because that's kind of interesting. Factor analysis. And just take a look at what happened over the last month or so, since things have kind of turned around. Now, what's fallen the most in this case is IPOs. So those are recently issued stocks. A lot of those, remember, were growth stocks. Growth as a style has sold off the most. That's down about 1% over the last month. This is for the S&P 500. And the styles which have done best have actually been things like small caps, which I'm glad of, because I bought some small caps a while ago in the US because they were looking reasonably valued. So is this a return to fundamentals? Maybe. Small cap value's also done well. That's up 4% over the last month. So perhaps this is simply a snapping back to fundamentals and people not believing the hype as much as they did in the past, perhaps. But it's certainly quite a marked turnaround for the Nasdaq, certainly. Now, if we do look at valuations, so if we look at the trackers on PensionCraft, you can see that the US is still looking pretty expensive even after this really modest sell-off. So the forecast earnings haven't really changed that much. We've got the third quarter of successive falls, year-on-year falls in earnings. We're about to see that. This is the third quarter that we're about to get the results of. And usually that's a fairly bad sign for stocks. If you get 3 successive quarters of year-on-year falls in profits, well, that's not good. And yet we've still seen this huge rally off the back of it. But of course, the rally was in the stocks which did generate very good earnings growth. But even after this slight sell-off, you can see that the valuation of the S&P, this is since yesterday's close, is still above the 5-year average. It's still above the 10-year average, and it's way above the 60-year average, which I'd say was fair value for the S&P based on the forecast earnings over the next year of about $234. So people are still paying a lot for less profits. So I think there's a lot of room for this correction to continue. Would I change my core allocation, which is 100% equity? No, because I don't do that. I know that I've got that money tied up for a long period of time, so I'm sticking with a 100% global equity fund. Anyway, so the video this Saturday, out of interest, is going to be about the choice of global index fund and which funds are probably going to be the best choice to stick with if you do want that global equity exposure, which gives you that long-term growth in capital. And I think really it depends on, well, you can see the video. It's kind of interesting, I think, to have that choice. Yeah, and also while we're on the subject of trackers, I just launched a new one, which is kind of fun. And remember, this is for members only. This is likely to rile some active fund managers because what you can do is you can type in the name of a fund. So you type in the Yahoo Finance ticker for a fund, and then, so this is Capital Gearing Trust. You tell it how many funds to use, and then it goes to a portfolio of cheap funds and it tries to match that portfolio, that fund, as closely as possible using cheap funds. So here you can see that we've got Capital Gearing Trust. The red line is the cumulative return for this replicating portfolio. The blue line is Capital Gearing Trust. And you can see that the portfolio matches fairly well. In fact, recently it's outperformed, although it's not trying to do that. It's not trying to outperform. But this is a combination of 80% life strategy, this legal and general cash fund, so that's a money market fund, and physical gold. And the proportions you can see are 42%, 34 and 24. And that does a reasonable job of matching it. And another fun thing, which I tried actually, let's get Yahoo Finance up so I can look up the ticker for this fund. Now, a really popular active fund in the UK is Terry Smith's Terry Smith Global Fundsmith Fund. Fundsmith. Let's use the share class T. So we'll use this ticker and try and replicate this portfolio more cheaply. So let's type that into the ticker box here, and we'll use 3 funds. Say you can use up to 5 funds to replicate, but let's use 3. And you can see you can match Terry Smith's return since 2018 quite closely with just 3 funds. One of them's this quality factor fund that makes up 38% of the portfolio, some NASDAQ tracker, that's 34%, and a little bit of bonds in there as well, about 29% bonds. You can do actually a fairly good job with just 2 funds. It's that quality factor fund probably. So that goes for quality stocks. Remember, Terry Smith goes for quality as well. And now we've just got Russell Growth and Life Strategy 60. So but it's kind of fun to play around with just to see whether you can copy the returns of a fund reasonably well. And it's surprising which funds it manages to do a pretty good job of. And remember, these are high fee funds. So for Fundsmith, you're paying about 1% per year. For this portfolio, you'd probably pay a lot less, probably less than 0.2% overall. So that's a kind of fun tool for members if you want to have a play with that. Anyway, so I'm not here just to sell PensionCraft. I'm here to help you. So I will switch back to me talking. There we are. And I'll move this thing over here. And so yes, please do ask a question. And I should also mention, I'm quite excited about this. I'll be speaking to Damien, who does the Damien Talks Money YouTube channel. So we'll be doing a live stream together on the 24th of August, hopefully. You know, it's not set in stone. We've got to sort out some tech issues. But if we can, we'll do a live stream together. That would be lots of fun, I think. And we can rant together about the pension reforms in the UK, the Mansion House speech and the pension reforms, talk about markets or anything Damien wants to talk about. That would be good fun. Because it is quite lonely as a YouTuber, finance YouTuber, and it's kind of fun to bounce ideas around with somebody else who does a similar job. So, and I also did a podcast on Damien's Making Money podcast, which I don't think's been released yet, but that was just loads of fun. It's him and his partner T, who a partner in the sense of podcast partner, I should say. who interviewed me, and it was just lots of fun. We had quite a laugh. Quite a laugh after the session as well, and before. And I got to meet their dog, who's very cute, who's called Toothless. Very sweet. Anyway, so let me just switch off Slack. That's making noises. So yeah, do ask a question, and if you do support us on YouTube, we'll see a little crown next to your name, and we'll answer your question first. And also, if you do a super chat, obviously it helps us financially. We'd really appreciate it if you did that, because again, we'll push you to the front of the queue. Laura, eagle-eyed as ever, will be looking for those super chats. So please do super chat, and any kind of contribution you can make, we'd appreciate it, and we'll push you to the front of the queue. So let me go back to your questions, and let's see what we've got. McCready747 says, go Teddy. Yeah, Teddy didn't waste any time. Of course, he's disappeared now. He's not under the desk. Fad Jaffrey says he's a big fan. I suspect that's of Teddy. And first question. Let's see if we've got any questions from members. Not yet. Okay. So the first question is, what's your outlook for the FTSE 250, please? Well, let's have a look at the FTSE 250, just out of interest. Let's look at a tracker, which is VMID. That's the FTSE 250 tracker from Vanguard. And let's look at the price and volume for it. So let me share my screen. There we go. And we'll take away these two moving averages, and we'll expand it a bit more. There we go. So that's pretty much since 2014. This is the big sell-off we got in with the COVID. And then, whereas with the US, we had this huge rally upwards, for the FTSE 250, no such rally. What's also interesting is if we look at the dividend yield for the FTSE 250, because that's the kind of attraction, right, for the FTSE 250, which is its income. And currently the dividend yield is 3.35%. This is the trailing 12 months. So you look at the cumulative dividend paid over the previous 12 months, and you divide by the price today and express that as a percentage. So that if you'd have paid £1 today, the income that was generated over the last year, what would that be as a percentage? And currently it's around 3.3%. Now it did go up a lot with a big sell-off in March of 2020. It went up to 4.9%. So that was an incredibly attractive buy. But currently the yield is not so good, right? 3.3%. If you can earn 5% with short-term UK government bonds, which you can, or with a money market fund, you'll earn not much less than 5%, where you're taking almost no credit risk, almost zero volatility. Compare that with the FTSE 250, which is generating 3.4%. And you'd be thinking, well, why would I take that risk of something which is likely to crash in future compared with something which won't crash because something cash-like doesn't? Then, it just becomes much less attractive. So I think in this kind of environment, which is a high yield environment, you always compare with the risk-free asset to see what return it generates. And if that's returning 5%, this is returning 3.4%, well, that doesn't look great. So I think the FTSE 250 is not particularly attractive right now. It is cheap. That's true. That's what it's got going for it. It does pay a fairly high dividend, but you can see that the dividend yield is not particularly attractive right now. So that's why I'd be fairly not positive, fairly negative about the outlook for the FTSE 250 right now. Also, the FTSE 250 is quite domestically driven in terms of its revenue. And if that's the case, then it depends heavily on the UK's performance as an economy. Now, a lot of the outlooks, if you look across G7, are just not great. If you compare the UK with the outlook for other countries like the US, It just doesn't look great in terms of economic growth. And if we are generating revenue from domestic sources, which the FTSE 250 does, then it's not so attractive. I mean, the FTSE 100 at least is more global in terms of revenue generation, and it does have lots of multinationals in the top 5, top 10 holdings. So that's why, if I did have to choose a UK FTSE index, it would probably be the FTSE 100 rather than the 250, which is more domestically oriented. But what's the outlook for the FTSE 250? Less than the US, I'd say, over the mid to long term, because of the economic growth problems, but also because of the domestic orientation of the index, and also because yields in the UK are just much more attractive at the short end of the curve. If you look at gilts. So let's do that actually, because we can do that with Koifin as well. Let's pull up the yields dashboard and look at the UK yield curve. So this column here gives you the UK yield curve. You can see the 1 year point is 5.1%, and then it falls fairly rapidly to 4.7 for the 3 year, and even for the 30 year it's only 4.6. So an inverted yield curve favouring short-term government bonds, which give you much more than the FTSE 250 in terms of yield. And if we look at the history of the US and UK 30-year yield, let's add the UK short-term rate, because that's driven by policy. UK, here we go, 1 year, and we'll take away the US. You can see that the inversion here, right? So you can see that the 30-year yield is below the 1 year yield, but just look how much that 1 year yield has risen. It has peaked, it seems, recently. So if we zoom in for 1 year, you can see that it peaked roughly in June. So over the last month, that's been falling, the 30-year yield, but the 1 year yield the 1 year yield peaked in June. It's been falling fairly steadily as the inflation worries started to ebb a little bit, and the Bank of England's policy response was expected to be not so extreme, because remember, people were talking about 6% for the yield, for the bank rate. Now they're not talking about that anymore. That's been revised downwards. That drives the 1 year past the yield curve, and the 30 year, that's still at around 4.6. So that factors in much more growth expectations for the UK and inflation expectations. Growth not so great, inflation probably is going to be sticky for a while. So yeah, yield has, at the short end of the curve, has come down a bit after the inflation expectations peaked, and currently it's still, I think, going to be high for a while, because the Bank of England's got its work cut out for it with very high core inflation, which hasn't really responded much to monetary policy from the Bank of England. And let me show you the Bank of England website, because I like to rant about this. So let's look up the Bank of England, our brilliant central bank. Let's look at their website to see their monetary policy report. Look, here it is. Let's click on that. And there it is. Very good. Let's have a look at the... Oh! That's great. So, yeah, this is our central bank. And this website has not been working for weeks. What are they thinking? It's a real embarrassment. Anyway, rant over. Back to your questions. So do we have any super chats? Yes, we have a member, a supporter, long-time supporter, Gary Cunningham. Thank you, Gary, for supporting us on YouTube. I love that crown next to your name. Why is Hong Kong not in emerging markets? Well, let's have a look at the history of... So MSCI has a nice fact sheet on this, which I really like. MSCI Index Family, I think it's called Family. And I'll share this with you in one sec, once I find the right thing. They used to have this beautiful graphic which showed all of their indices together in one place, and it kind of showed you how they're kind of broken down. And I can't find it now, of course. Okay. On a YouTube live, you can never. It's like a rule of nature that you can't find things. It's got market cap, equity fact sheets. Oh, maybe it's a long shot. No. Okay. Anyway, what I wanted to show you is a kind of grouping of the different different markets. But I think in the case of Hong Kong, certainly it's a historic thing. So remember that it wasn't always annexed to China. Now it's still part of a special economic zone, but of course it is very much part of China and has been for some time. But I guess it's kind of like a separate entity legally in some ways, certainly from the point of view of markets. And whereas capital trying to get to from foreign investors to Beijing or to the Shanghai Stock Exchange has to pass through this kind of narrow pipe. The exchange, let me find that. Hong Kong link stock market. What's the chance I can find it? About 0, I'd say. There used to be a really nice website which had the link between the two, and it would tell you how much money had flowed in the link between Hong Kong and the onshore market in China. Shanghai Stock Connect, here we go. And it used to tell you exactly how much money had flown, had kind of flowed between the two, not flown, get that right. Here we go, and I will share my screen in moments. No, that's not the one that's going to show you. Stock Connect, here we go. I think the Hong Kong version is better. Yeah, here we go. So this shows you Hong Kong Stock Connect, and it shows you how much money is flowing to Shanghai and to Shenzhen, and how much money is flowing either way. And the way they describe it is northbound and southbound, right? So northbound is going to China, southbound is coming out of China, and so you can see the numbers here. And it's kind of interesting to look at the flows, but I think they're still restricted. Whereas if you trade in Hong Kong as someone from the West, I think there are still no controls in terms of amounts that you can buy and sell. Whereas if you as a foreigner try to invest in Shanghai or Shenzhen, those markets, then either you have to be a qualified professional investor, which means usually that you'll be an investment bank like Goldman Sachs or UBS, or you have to go via this Connect route. So yeah, so in that sense Hong Kong is still a kind of open market, but so it's not really part of developed markets, but you can trade it as if it were. But that's a very fudgy answer. I don't think it is part of developed markets personally, but it is a big market. Certainly if you compare it with the size of some of the European markets, it's still quite chunky in terms of market cap, but also traded volume. But yeah, I think it's largely historic. And also, I think China still likes to have one toe in the water outside its own little sandbox of restricted capital, because effectively that means it's still part of global markets. Also, if Chinese companies want to raise capital, I guess they can still do that in Hong Kong, even though they might have had difficulty doing that now in New York due to political problems, shall we say. So it's not really developed markets, but it's treated as such. And I don't know whether MSCI treats it as EM countries. MSCI country membership, here we go. Market classification. Maybe this is the document I was after. Market classification. Oh, please be the right one. Yes! Okay, let me share. This is what I was after. Finally, I found it. So if we look on developed markets in Asia, you can see that Hong Kong, APAC, is still considered part of developed markets, certainly by MSCI. Another weird thing about MSCI is that it treats South Korea as if it was emerging markets. Where is it? South Korea. At least it used to. Where is South Korea? Can't see it on there. That's odd. South Korea. Nope, can't see it. But oh yeah, here we go. Korea. It's assumed to be south. Okay, so Korea's here, and it's considered to be part of emerging markets, but not by FTSE Russell, interestingly. But you can see here that Hong Kong is still treated as part of developed markets for whatever reason. It is kind of odd, isn't it? I agree, that's odd. Anyway, I just thought I'd share that. It's always interesting to see how these indices are carved up. I think when we look at this in 10 years' time, it'll be quite different. Some of these emerging markets won't be. They'll be in developed. And some of these frontier markets, of course, will be emerging. Or maybe the whole label of emerging markets might just go away. And, saying that China's emerging, what does that mean? It's such a different country from some of these small EM countries like Malaysia, the Philippines, Taiwan, Thailand. All of those are so different from China that it really kind of defies classification of what it is. But I think most people at the moment would agree that it's uninvestable. Okay, that's what a lot of people think of it as being, which is of course why it's cheap. Okay, so back to your questions, and we have another super chat. This is from Dave Sylvester. Laura tells me off if I don't move fast enough, so if I spend too long on a question, she tells me to move on. Dave says, it's a super chat. Thank you, Dave. Great content. Thank you. What do you think about recent Mansion House rules in putting a percentage of pension schemes in high-risk UK startups, especially with Vanguard Life Strategy over UK weighted? Yeah. Now, I will talk about this. I was hoping to talk about this with Damien on a live stream on the 24th. I mentioned it at the beginning because it's nice to have a rant about these things. So let me start ranting. So what is the problem? Okay, the problem with the UK at the moment is that defined benefit pensions don't have a large enough allocation to stocks. They have something like, I think from memory, it's something like 20% stock allocation, which is incredibly low. So the domestic source of capital, which is pension money, is itself avoiding putting money into stocks. This means that the cost of capital is higher in the stock market for the UK. Other investors globally also don't favour the UK. So that means that UK valuations are quite low relative to the rest of the world. We're cheap as a market. The government is trying to do the right thing, which is trying to get more money to move into the capital markets, into the equity market in particular. However, what it's doing is trying to put money into private equity. What's the problem with that? Well, private equity, remember, is actively managed. Usually it's actively managed with a very high fee, which is usually upwards of 2%. Usually there's also some kind of performance-related fee, so that if it outperforms a certain high watermark, a certain percentage of return, then it also skims off some of those extra profits if it does well. I mean, you could claim that's an incentive bonus, or you could just say that's egregious fees. I'd tend towards the egregious fees point of view. So what's the risk with private equity? Remember, this is often early startup companies. Not always. It could be mezzanine capital. It could be just expanding large companies which are already successful. But usually it's higher risk. So what we've got is high risk investments which usually reduced the returns by very high fees, and that's your pension money. Now, I don't think it's right for the government to say we're going to force you to put your life savings into these high-risk investments with very high fees, because the people who are going to benefit without question are the private equity fund managers, because they will reap the reward of higher assets under management if the government's siphoning money their way. It's always going to be interesting to see which politicians have pushed for this, because if they've got friends who are in private equity, there's something for an investigative journalist to look at there. But is it good for investors in the UK or savers who probably aren't even aware that their money is being put into private equity? No, it's a disaster. And I think it's a huge mistake. Pushing more money into stock markets, UK stock markets, that would be more acceptable because you can trade those on a fairly low fee basis. But putting it into private equity, what are they thinking? This is crazy. And you should watch Damien's video about it. Damo, as I call him, has some quite funny comments where he actually he phones the regulator. This is hilarious, and says, you know, there's this high risk investment with very high fees. Do you think that's acceptable by your rules or something like that? We'll discuss it when we talk to each other. But of course, they kind of come up with a wishy-washy answer, but clearly not good for investors and a huge mistake, I think, from the UK government. But I suspect that there's not much more pushback from pension fund managers because they probably think, well, this government's not going to be in power for long anyway. So if we just ignore this, it'll just go away. It's not worth kicking up a fuss, would be my guess. But do I think it's a good idea? No. I think it's a terrible idea. There we are. Second rant over. Very good. So I hope that answered your question, Dave. Move on. Daniel Cooper, also a super chat. Thank you, Daniel. He says the fund XDEV fact sheet shows the ETF currency composition is very diversified, but the KIID, the Key Investor Information Document, KIID, says the currency of the fund is US dollars. Could you explain? Yes. So let's pull up the fact sheet just because then we'll see it together. Very good. PlayStation Studios, I think that's the wrong link. ETF. And this is an X-Trackers one, and their website's okay, I seem to remember. Am I a retail client? Yes. Yes. Accept terms and conditions. I did accept. There we go. XDEV. Right, so let's search for XDEV together. This is literally like watching paint dry. I'm sorry for this. XDEV. Nice if I could find it. Is this XDEV? That's the ISIN code. MSCI World. Let's have a look at the KIID anyway. Documents. Here's the KIID and the fact sheet. So let's look at the fact sheet first. So this is a it's tracking MSCI World Enhanced Value Index. And is it XDEV first of all? Let's check. XDEV. Yes, it is. Okay, so we're looking at the right fund. Good start. The MSCI World Enhanced Value Index. So now let's look at that index because that's what it's tracking. So it's large and mid-cap companies from global developed markets selected using a value strategy. And how does it work out value? Well, it uses things like price to book value, price to forward earnings, and enterprise value to cash flow from operations. And it sounds like it's reviewed on a semi-annual basis. So let's have a look at the index itself. Now notice that the index, often these global indices are valued in dollars. Now what I assume is happening here is, let's see how this portfolio is replicated. Is it synthetic? direct replication. So that means that it's going to be actually buying the stocks in the index. Let's see how many stocks it buys. Maybe it'll tell us. So here are the countries that it gives you exposure to. Notice that what's kind of interesting is the US has got a huge underweight relative to market cap, presumably because the US is overvalued right now, with a big overweight for Japan, big overweight for the UK. That would be half of that if it was market cap weighted, and a fair old chunk dedicated to Europe as well. And how many stocks has it got? Does it tell us? Number of securities is 403. How many in the index? That has 400 in the index. So yeah, it is buying all of the stocks in the index. It is directly replicating them, and it'll be weighted according to the weights that it pays for from MSCI. It pays a fee for that to MSCI, and so what's going on here in terms of currencies? So let's say you buy some of this fund from who is it? Xtrackers. What's going to happen to your money? Well, if enough people buy the fund, your allocation probably wouldn't be enough to tip it over the edge. But if enough people bought, then there'd be a new unit of the fund created. So the money would flow into Xtrackers, their coffers. Then what would happen would be that that money would then be used to buy a basket of stocks, which in this case would be the stocks in this index, the MSCI World Value stocks, those 400 stocks, in the weights prescribed by MSCI. Then the authorized participant, who's the person who's creating this unit of ETF, usually an investment bank, would deliver that basket of stocks to the fund manager, which is Xtrackers, who in return would give them a unit of the ETF. Now the two have the same price. If they don't, then that encourages the market participant to do the arbitrage between the ETF and the basket of stocks. But in this case, they'd have created a unit of the stock, of the ETF stock, and so that's how money flows into the fund. But in terms of your flow of cash into the fund, what would happen would be that each of those stocks trades in a different currency, and the currency conversion would be done by the fund manager or the authorized participant, which is buying the basket of stocks. So you don't have to worry about the currency conversion. They've chosen to use dollars as the fund currency, so they'd probably use that as a numeraire when they're doing their trades. Of course, when they buy the individual shares in Japan, in Europe, they'd use the currency that was appropriate for that exchange. But the numeraire, which is used to value the stock, to value the fund, is the US dollar. So usually it's best to go for a fund which does the currency conversion for you. So if you're going to buy a global fund, it's usually best to go for a sterling denominated version of the fund. So let's just see if there is one for this fund. In this case, yes, there is. So let me share this with you. Usually there'll be multiple listings of the ETF, all with slightly different tickers. So you can see it trades on these 4 different exchanges in Europe. Xetra in Germany. That trades in euros because it's in Europe. London Stock Exchange, the ticker there is XDEV on XDEV LN, which means it's the London Exchange, and that trades in sterling. So if you buy it in sterling, it'll be converted into dollars. Then it'll be, if they have to create more units, it'll be converted into whatever currencies are required according to the constituents of the index. And then if you pull your money out, everything will happen in reverse. Probably it'll get changed to dollars and then it'll come back into sterling, but it's a fund manager which will do the conversions, usually at a much cheaper rate than you'd pay, because this is an institutional investor and they get immensely competitive bid offer spreads for currency. And then it also trades on the Swiss Stock Exchange and the Italian stock exchange. And Teddy's come back for seconds. There we go. You pick a fine time, Ted. Go on then. Actually, eat it down there because it's noisy. Okay. So this one trades on 4 exchanges, and the currency conversions will be looked after for you. It is confusing that it's quoted in dollars, but the individual currencies which make up the basket of stocks would depend on the country in which you're buying the underlying assets. But all of that is taken care of for you and then munged up into $1 price based on the spot value of the currency conversion rate on that day. And then if you look at the sterling version, that again will be converted from dollars to pounds if you're looking at the sterling version of the ETF, which trades on the LSE, the London Stock Exchange. So complex, but I mean that's the beauty of ETFs, which is that they hide a lot of this complexity inside a very low fee, efficient wrapper and take a lot of the grief out of it for you. So just imagine before ETFs what you'd have had to do to replicate this. You'd have had to be able to trade on multiple exchanges in multiple currencies, and you'd have had to continually churn the portfolio. For a value fund like this, you'd have had to work out the values of individual funds, individual stocks, compare them to the rest of their peers, work out the weightings, and then maintain those weightings as the valuations changed. It would have been a nightmare. So for the sake of, fairly low fee, they're going to do this for you. What is the fee for this one? Ongoing charges. Will they tell us? Let's hope. What kind of fact sheet doesn't tell you the fee? So 0.25. I mean, that's a lot of work for 0.25, but you could probably get it a bit cheaper than that. But for a value fund, that's not too unreasonable. So yeah, a lot of stuff done for you and a lot of complexity hidden fairly cheaply inside the structure, which is kind of cool. So you're still hanging around, mate. Do you want another treat? Okay, one more. Okay. Right, so there we go. That's the long and the short of it. I hope that was helpful. And there's a super chat. Thank you, Fad Jaffrey. Looks like we're getting lots of super chats this evening. That's great. Thank you. Who says, not really a question, but issues with the UK economy stem mainly from its political instability. Thoughts? Yes, I think politicians and finance. I mean, if you speak to people in banking, they treat politicians as almost like a comedy, and people assume that bankers are very right wing or kind of very kind of money oriented, but usually they're fairly practical when it comes to politics or any other matter. And really all that the people in finance want from the government is not to break the economy. Just keep things chugging along, keep growth preferably high. Don't tank the economy. Don't throw fuel on the fire when inflation is high by having a very inflationary budget, which is unfunded, having just fired the head of the civil service and having ignored advice from the Office for Budget Responsibility. That would clearly be a foolish thing to do, and that was an embarrassment. So don't break the economy. Keep it politically stable. Do care about business. Don't tell business to F off, which I believe was a direct quote from our Prime Minister at one point. That's all that's required, just to keep the show on the road and not break things. And yet, what surprises me is that a Conservative government, delving into politics here, which I don't usually, but it surprises me that a Conservative government has done such a poor job of being a guardian of the economy and not kept things stable and swapped prime ministers at an alarming rate, which usually you'd expect in an emerging market country. That's really disappointing. And I think markets have punished the UK. Investors have punished the UK market as a result. That's why our valuations are so low. That's why foreign investment into the UK is so so limited, and that's worrying. So I think really all that's expected is not to break it, keep it working. It's kind of like an operating system. The best operating systems on a computer are when you don't see the operating system. It doesn't really break things. It doesn't really get in your way. You can just do things that you want to do without really even noticing it. And clearly, this operating system is not working very well. But it sounds like we're going to get a different operating system pretty soon in the next election. So let's see what the next bunch of Muppets can manage after this lot. So, bit of politics there, which I don't usually talk about, but certainly when it intrudes into markets and when we had huge problems with the Kwarteng Trust budget, I did kind of rant about that. But that's all that's expected, I think, Fard. Next question is from VideoPack, who's based in Switzerland, I think, because it's Swiss francs that they paid in. How should a Swiss investor, yes, it is Switzerland then, deal with a stronger and stronger Swiss franc versus sterling, dollar, euro? Currency hedging, domestic versus international investing? Good question. I did have a Swiss affiliation in the past, so it's something I used to think about. But if you have got a strengthening currency, it's always worthwhile looking at the PPP value of Swiss franc versus the dollar, say. Let's look it up, because that's kind of interesting. PPP, Swiss franc, and the IMF publishes this. There we go. And again, let me share my screen. There we go. So let's look up Switzerland on here. How does this work? Well, it's based on the purchasing power of a particular currency. So how much stuff does a Swiss franc buy? How much stuff does a dollar buy? Using an equivalent basket of stuff, which that's what the OECD's done here. And if the two buying powers are set to be equal, what currency conversion rate would do that to make the purchasing power equal? And I've forgotten which row it was now. Swiss franc is, Switzerland is 1, 2, 3, 4, 1, 2, 3, 4, 5 from the bottom. So 1, 2, 3, 4, 5. So it's 1.052, I think. Let me just see if I can, yeah, 1.052 as of 2022. And let's see what the current Swiss franc rate is. Uh, 0.88. So I think it's the reciprocal that we're after here. That's 1 over 1.552. What was it? 1 over 1.052. So it's just under 1 Swiss franc to the dollar. So it's not that far off. Let's work it out. 1.05. What was it? 1.052. There we go. So 1 over 1.052, and that would be about 0.95. So 0.88 and 0.95. So it should be weaker. Should be not far off parity. And I remember for a while there was almost parity for the Swiss franc. And clearly recently, let's go over the last 5 years, the so $1 is less Swiss francs because the Swiss franc's been strengthening, but it looks like it's overdone. This strengthening of the Swiss franc, it should be closer to parity. So based on fundamentals, I wouldn't panic that much. I think probably the Swiss franc is doing so well, or at least doing well, strengthening so much because it is a safe haven. And I think people are getting quite nervous at the moment about the market rally in the US. So I think probably what will happen is it'll probably, if we believe purchasing power parity, it'll go back closer to parity for the Swiss franc. So I think there will be a weakening. But who knows with currency? It's just almost impossible to predict. It's much less predictable than, say, stock markets. Let's have a look at the currency rates as well, the yields as well, because that is the driver. Have we got Swiss franc rates here? We haven't, unfortunately. If we have the yield curve for Switzerland, let's pull that up. It's got Switzerland. No, can't see Switzerland. No, it's just got the 10-year rate. Let's have a look at that. We'll compare it with the US. So if the currency, if you've got a higher interest rate in Switzerland than the US, then that would tend to strengthen the Swiss franc. So let's do it for the US, not for the UK. There we go. So what we've got here is the 10-year rate for the US with 10-year rate for Switzerland. And Switzerland's rates are still around 1% at the 10-year part of the curve. US rates are around 4%. Usually what would happen would be that the dollar would strengthen versus the Swiss franc if this is the interest rate differential. Clearly that's not happening right now. So, both the interest rate differential and the purchasing power parity are both pointing to a weakening of the Swiss franc. So, maybe it will weaken. And if that's the case, it's probably not worth hedging. But these things almost impossible to predict, currency rates. So I'm not going to have a go. A lot of my friends were currency strategists and they just weren't very accurate, put it that way, at forecasting what would happen to currencies. There was a famous case where the peg for the Swiss franc to the euro broke, and a lot of banks failed to predict it. You'd have thought they'd have a better insight into that. But look, if you do think the Swiss franc is going to carry on strengthening, then yeah, hedge. If you think it's going to weaken, don't. But if you're kind of unsure, you can also partially hedge based on the probability you think of a strengthening or weakening. That's all I could offer. And then just base the probability, just base the ratio of hedged to unhedged on your probability of strengthening or weakening. That's probably the best you can do. But just don't have too much faith in your own ability to forecast currencies, because it is very difficult to do. So the final question from one of our YouTube super chats is from McCready747. Thank you, McCready747, who says, what do you think of QQQX, QYLD, covered call ETFs? Yeah, I did a whole video about them, actually. And I think if you're not familiar with it, the idea is that you sell the upside because you don't believe in it. So you get the fund manager sells the upside, and that way they enhance the yield of the fund. Because if you're selling an option, then that generates premium because you've sold an option which has value, and then that becomes income for the fund. What's the drawback? Well, the drawback is that if the index rallies, then you miss out on the upside because you sold it. So as long as markets kind of trend sideways or downwards, then these yield enhancement strategies work well. And the more volatile the stock market is, or the index, the greater the price of the premium, the greater the premium of the option you've sold, and the greater the income you get. So volatile sideways markets are the absolute ideal environment for these funds. So currently, yeah, the Nasdaq's selling off, it's moving sideways, it's falling, the volatility is increasing. So that's a pretty attractive environment, unless you think that the Nasdaq is going to start tearing upwards again. But let's face it, that's unlikely given where valuations stand. But if it did happen, obviously you'd miss out. But at the moment, yeah, I think higher volatility, sideways movement or downwards, slow downwards, because remember you've kept all the downside, make it attractive relative to holding the Nasdaq straight via QQQ, say, the Nasdaq tracker. So, you know, I think covered call ETFs in this kind of environment for the US are attractive. And in fact, I was thinking of buying one for the UK because QYLD is now listed in the UK. In fact, I might do that this week. That would be kind of fun. I think Laura bought some already. I think Laura bought some along with her Nvidia stock. You know, she bought some just for a bit of fun. So I might do that in my fund portfolio just to see how it works. Because the other interesting thing is if you look at the fact sheet, it's supposed to pay out monthly. But on a lot of the data sources for QYLD in the UK, it says it pays out every 6 months, which is clearly wrong. So, I mean, that'll clear it up, won't it? If I own it, I'll see when the dividends are paid. Anyway, how are we doing for time? Ted usually reappears. He's really good at timing things. He's a bit early today, but he appears after an hour when I have one-to-one coaching sessions. He can time an hour pretty well now, and he also hears a change in my voice, I think, for the end of a call. No more, mate. No more. Gonna be sick. Good. Okay. So how are we doing for time? We've got time for one more question. So I'll answer one of your questions as one of the non-members on the call. And let's see. One more swig of this. Choose carefully. Daniel Cooper says, I wish you'd scroll down to the bottom of that fact sheet of XDEV, which show the pie chart of the currency breakdown. However, thanks for answering. So let's scroll down to the bottom. Oh, here's the currency breakdown, so you can see it. Sorry, Daniel. It's the currency. But you can tell the currency breakdown from the country breakdown. It's the same thing, right? Roughly. Except for the euro, of course. There we go. But it didn't change the answer, really. Back to your questions. And we'll choose one. Look at the Swiss Central Bank balance sheet or versus US or EU. Yeah, I guess the Swiss Central Bank was kind of odd in that sense because it bought stocks as part of its holdings, which for a central bank is quite surprising, given it's risky. Thanks for all of your great work on these videos and live streams. This is Seb Fox. Gwen Guthrie said that there's no romance without finance. As an expert in finance, is this really true? No romance without finance. Yeah, I mean, you could say that marriage itself is just a way of getting around distribution of goods, isn't it? So, yeah, even something like marriage, which is supposed to be about romance, is ultimately about finance. Maybe that's a good way to end. Anyway, great question. I like that. So anyway, thank you all for joining us. Please do consider our membership because then you could benefit from those trackers that we saw earlier, particularly the one which lets you copy the returns of a portfolio using cheaper funds. That's good fun to play with. But also you get access to the other trackers about valuation, macroeconomic data and other things, but also members only videos and also chat, so you can discuss finance whenever you like and ask me a question whenever you like. Those are the benefits of membership. Also check out our podcast, which is Many Happy Returns. That's me and Michael Pugh who run that. And yeah, thank you all for joining us, and I hope you have a very good 2 weeks. Don't forget, August the 24th, hopefully I'll be joining Damien, who is from Damien Talks Money, about the Mansion House speech, but also other things to do with investment, which we haven't agreed yet, but which will be entertaining, whatever they are. Thank you all for joining us, and take care, and good luck with your portfolios.